theory is elegant and logical. If the United States pays a higher interest rate on its bonds than Europe does, capital should flow into the dollar. Money, after all, always hunts for the highest yield, but the bond market has a nasty habit of humiliating professors. Recently, we witnessed an anomaly that shouldn't exist in a functioning model. The gap between European and US bond yields widened by about 50 basis points, meaning the US was paying significantly more to borrow than its peers. According to the textbook, the dollar should have surged by 5% to capture that value. It didn't. Instead, the dollar crashed by 6.5%. If you are a trader staring at your terminal, that isn't just a bad day. That is a violation of physics. It is a very clear sign that something strange is going on beneath the surface of the global financial plumbing. The market was screaming that the extra interest the US was offering was no longer enough to compensate for the risk of holding the currency. To understand why this is terrifying, you have to understand a concept called convenience yield. Think of this not as a financial term, but as a sleep insurance premium. For 70 years, foreign central banks and investors were willing to accept lower returns on US treasuries compared to other assets. They happily gave up profit for the privilege of holding the world's safest asset. They paid a premium for the liquidity, the legal protection, and the absolute certainty that the dollar would be there tomorrow. That gap, historically averaging about 22 basis points, was the price of American credibility. But look at the data since 2022. That premium didn't just shrink, it evaporated. The spread on short-term treasuries has drifted down, hit zero, and then turned negative. Let that sink in. The special fee that the world used to pay us for the honor of holding our debt is gone. We are now seeing a flight out of treasuries. Investors are actively demanding a discount to hold US paper. It is the financial equivalent of a customer paying an extra fee just to close their bank account. You don't pay that exit fee because you found a better bank with a nicer lobby. You pay it because you have stopped trusting the manager of the bank you are in. The market has stripped the dollar of its risk-free halo. The correlation is flipped, and when the world stops paying for your safety, it means they have started pricing in your danger. This wasn't an accident. The market didn't just wake up one morning and decide the dollar was toxic. That fear was manufactured. It was a specific, calculated reaction to a decision made in Washington, a decision that turned the global financial system from a utility into a weapon. February 26, 2022, that is the date the global monetary system suffered a stroke. It wasn't a market crash. It wasn't a bank run. It was a press release. The United States and its allies announced the freezing of roughly $630 billion in Russian central bank reserves. For the average citizen, this looked like a necessary geopolitical punishment. But for every central banker in the global south, it looked like a breach of contract. For centuries, the unspoken rule of neutral reserve currency status was simple. Sovereign reserves are sacrosanct. You might go to war with a country, you might embargo their goods, but you do not touch the national savings sitting in your banks. That money is the property of the state, not a tool of foreign policy. In a single weekend, Washington shredded that contract. The message sent to the world was brutal in its clarity. Your money is only yours, as long as we agree with your politics. The moment you cross a red line drawn in Washington, your national savings don't just get devalued, they get deleted. The US dollar ceased to be a neutral medium of exchange and transformed into a political projectile. This is the moment the concept of risk-free actually died. The reaction from the non-aligned world, nations like Brazil, India, and Saudi Arabia, was not public outrage. It was quiet, calculated panic. They weren't sympathetic to the invasion, they were terrified for their own balance sheets. They looked at Russia and saw a ghost of their own future. If the US can turn off the lights for a nuclear power with the world's 11th largest economy, what chance does a smaller nation have if they disagree with American policy on oil production, trade tariffs, or human rights? This created a fundamental shift in the calculus of holding dollars. We moved from a security premium, where you pay for safety, to a security penalty. Holding US Treasury bonds now carries a hidden cost, the risk of confiscation. It is a penalty for being vulnerable to American leverage, and the data supports this fear. The use of financial sanctions has exploded. Since 2017, the number of entities and nations targeted by US financial warfare has skyrocketed. The weapon isn't being used sparingly anymore. It is the default setting for foreign policy. The irony here is almost tragic in its scope. We thought we were putting handcuffs on a rival. In reality, we handed every neutral nation the key to unlock their own handcuffs and walk away. By weaponizing the system, we didn't force loyalty, we incentivized defection. We proved to the world that they need an alternative, not because they hate the dollar, but because they can no longer afford the risk of holding it. We turned our greatest asset into our greatest liability, and history is very clear on this specific point. Once a reserve currency is weaponized against its users, the trust doesn't just fade, it breaks, and it never heals. We often discuss the decline of the dollar as an abstract geopolitical drama, like a weather report for a storm that's still 1,000 miles out at sea. We talk about shifts in hegemony and multipolarity, as if they are just headlines. But for the person sitting in a suburban home in Ohio or a tech hub in Austin, those words are empty until you attach a price tag to them. So let's attach one. Based on quantitative modeling, the total bill for the loss of the dollar's reserve status is roughly $29 trillion. That isn't a conspiracy number. It is a mathematical projection of what happens when the exorbitant privilege we've enjoyed for 70 years is revoked. For decades, the US has exported liquidity services to the world. We gave the world a safe place to park their money, and in exchange, they gave us lower interest rates and a stronger currency than we actually deserved. If that global demand for safe dollars vanishes, the economy is forced into a violent recalibration. First, interest rates would rise by approximately 92 basis points, nearly a full percent, permanently. In a vacuum, 1% sounds manageable. In a debt-saturated economy, it is a sledgehammer. It means every mortgage, every small business loan, and every credit card balance in America becomes more expensive to carry forever. But the real trauma isn't in the interest rates. It's in the valuation of everything you own. The loss of the dollar's special status would result in a net wealth loss equivalent to 93% of US GDP. Imagine the total value of everything produced in America in a single year. Every car, every software license, every burger, and then realize that nearly that entire amount of wealth would simply evaporate from the nation's balance sheet. This is the repricing of American life. It means your 401k doesn't just dip. It recalibrates to a world where American companies no longer have the home field advantage of the world's currency. It means the equity in your home, the wealth you've spent 30 years building, is suddenly worth less because the cost of borrowing has shifted the floor of the entire real estate market. This isn't inflation like we saw in 2022, where the price of eggs went up. This is the structural erosion of the prosperity we've inherited since 1944. It is the bill for 70 years of living on the world's credit card finally being delivered to your front door. The system's defenders will tell you this is impossible, because there is no alternative. They want you to believe that as long as the euro is weak and the yuan is closed, the dollar is safe by default. But they are looking for a new king, while the rest of the world is busy learning how to live without one. Whenever the cracks in the dollar's foundation become too wide to ignore, the establishment always retreats to a single comfortable defense. They call it TINA. There is no alternative. They point to the euro and call it a dysfunctional committee. They look at the Japanese yen and see a demographic sunset. They look at the Chinese yuan and dismiss it because of capital controls and a lack of transparency. They ask with a smug sense of security, if not the dollar, then what? What is the new king? They are asking the wrong question. They are looking for a new monolith to replace the old one. But history doesn't always trade one king for another. Sometimes it just burns down the palace and lets everyone go home. The truth is, there will be no single replacement for the US dollar. We aren't moving toward a new unipolar world led by Beijing. We are moving toward fragmentation. Imagine a global marketplace where people have stopped using a single universal credit card. Instead, they've started bartering or using local vouchers. This is what we are seeing today. India is now paying for Russian oil using the UAE dirham. China and Brazil are settling trade in their own currencies to bypass the dollar entirely. Saudi Arabia, the cornerstone of the petrodollar, is now openly discussing pricing oil in yuan for its transactions with China. The world isn't waiting for a perfect alternative to the dollar. They are simply building parallel plumbing. China has developed CPS, the cross-border interbank payment system, as a direct competitor to the Western-dominated SWIFT. Russia has its own financial messaging system, FMS. These aren't just technical upgrades. They are lifeboats. The irony is thick here. Our leaders told us that the dollar's dominance was safe because there was no other world currency ready to take the throne. But they forgot that you don't need a new throne to end a monarchy. You just need enough people to stop showing up at the court. We are witnessing a de-dollarization, not by grand design but by 1,000 small defections. Central banks are buying gold at levels not seen in decades, because gold is the only reserve asset that isn't someone else's liability. They are diversifying because they've realized that being part of a unipolar system is only a benefit as long as the pole doesn't try to hit you with it. We are entering a world of monetary tribes. It will be less efficient, more expensive, and far more volatile. But for the rest of the world, that is a price they are willing to pay for autonomy. The palace is being dismantled, brick by brick, not to build a new one, but to build thousands of smaller fortified walls. And as those walls go up, the exorbitant privilege that funded the American dream for 70 years is quietly bleeding out into the dirt. But don't be fooled into thinking this is a tragedy being written in foreign capitals. The most effective demolition crew isn't in Beijing or Moscow. They are much closer to home. There is a comforting narrative often sold on cable news that the decline of the dollar is a grand conspiracy orchestrated in Beijing or a tactical siege launched from Moscow. It's an easy story to tell because it provides an external villain, but the data suggests a much darker reality. If the dollar is a fortress, the walls aren't being knocked down from the outside. The foundation is being dissolved from within. The greatest threat to the American dollar doesn't speak Mandarin or Russian, it speaks English. We have entered an era of US internal dysfunction, a state where the very institutions designed to protect the currency have become its primary predators. Consider the Federal Reserve. For a century, the myth of Fed independence was the bedrock of global trust. Investors believed that no matter how chaotic Washington became, the adults in the room would protect the value of the currency. That myth is dying. We are witnessing the slow-motion politicization of the Fed, where monetary policy is increasingly used as a fire extinguisher for bad fiscal decisions. When the government spends what it does not have, the Fed is forced to monetize that debt, effectively devaluing the labor and savings of every person holding a dollar. Then there is the theater of the debt ceiling. Every few years, the world watches as the full faith and credit of the United States is used as a bargaining chip in a game of political chicken. To a foreign observer, this isn't just a political squabble, it's a sign of a regime that has lost its grip on basic arithmetic. A government that threatens to default on its own debt to win a news cycle is not a government that can be trusted with the world's reserve currency. The irony is as dry as it is bitter. We lecture the world on structural reforms while our own national debt has decoupled from any semblance of reality. We have created a culture where printing to survive is the only remaining policy tool. It is the financial equivalent of burning your own house's furniture to stay warm for one more night. As one commentator noted, the irony is that the only real threat to the dollar's dominance is the dysfunction of America itself. We are a nation that has forgotten that a currency is a promise, and you cannot keep a promise to the world if you are busy breaking promises to your own future. We spend our time scouting the horizon for dollar killers like the yuan or the BRICS, but we are the ones holding the smoking gun. We are shooting ourselves in the foot and then blaming the quality of our shoes. We have turned the exorbitant privilege into an exorbitant debt, and we are fast approaching the point where the world realizes that our word is no longer as good as gold. So if the internal rot is this deep, and the external lifeboats are already being built, where does that leave the person who is still standing on the deck of this ship? What does it look like to live in the aftermath? The air is thinning at the top of the mountain. For 70 years we lived in a historical anomaly, a golden era where the dollar was the undisputed sun, around which every other asset orbited. But as the convenience yield evaporates and the world builds its parallel plumbing, we have to ask, when the music finally stops, who is left to clean up the mess? The answer, as history suggests, is anyone still holding the old promises. We are entering what economists call a multipolar reality, but for you it simply feels like a more expensive world. The days of cheap capital and exported inflation are behind us. The new normal is higher structural interest rates, as the US government competes for a shrinking pool of global lenders. It is a world where safety is no longer a default setting you get for free. It is a commodity you have to fight for. In this environment, diversification is no longer a cliché from a brochure, it is a survival tactic. The smartest money in the room, the sovereign wealth funds, the ultra-elite, the central banks, already showed their hand years ago. They didn't wait for a televised announcement of the dollar's decline. They began accumulating gold at record paces because they recognized that in a world of weaponized finance, an asset that belongs to no government is the only true insurance. They aren't betting on the total collapse of America, they are simply betting against the permanence of its dominance. The irony is that the system will continue to tell you everything is fine. It has to. A reserve currency only survives as long as the majority believes the exit door is still open. But the elite have already moved toward the exit, quietly trading their paper promises for hard assets like gold, strategic commodities, and alternative payment infrastructures. You are now facing the same choice they did. You can choose to believe the Tina myth, that there is no alternative and thus nothing to fear, or you can accept the reality of the security penalty and recognize that the ground beneath the dollar is no longer solid. Living in the aftermath doesn't mean the world ends, it just means the rules have changed. Those who continue to play by the 1990s playbook will be the ones who fund the transition for everyone else. It is a cold realization. The exorbitant privilege was a loan, not a gift, and the global creditors are starting to ask for their collateral back. As we stand at this crossroads, the question is no longer about the fate of an empire. The fate of empires is a matter of historical record. The only question that remains is what you intend to do with the information that the empire itself is trying to ignore. History does not move in a straight line. It moves in cycles. We have lived our entire lives within a historical anomaly, a world where one currency was the undisputed center of gravity, but that era was a loan, not a permanent gift. Today, history is simply returning to its natural state, a state of friction, competition, and multipolarity. The final irony of our current financial system is that it was built on the arrogant belief that tomorrow would always look exactly like today. Yet the data tells a different story. When the fear index no longer drives capital toward the dollar, and when the security premium of American debt turns into a penalty, the foundation has already shifted. You do not need to predict the exact minute the tide will go out. You only need to look at the shoreline to see that the water is already receding. The exorbitant privilege is being revoked, not by a single enemy but by the weight of our own internal contradictions. The system will not tell you when to leave. It is designed to keep you inside until the very end. The question is no longer what the empire will do, but what you will do now that you can see the mechanics behind the curtain. If you are ready to stop looking at the surface and start decoding the systems that govern your wealth, leave a 19-1 in the comments. Welcome to Financial Money History.